So in this video, I'm going to talk about forward rates and why they're different from spot rates. So as I mentioned in the previous video, forwards are a contract which basically obliges you to buy or sell a certain currency against another currency at some point in the future. So when you see forward rates quoted and future rates as well, you'll see that the exchange rate is not the same as the spot rate. The spot rate just refers to cash rate, i.e. A trade carried out for immediate delivery. Actually turns out it's not always immediate delivery, it's 2 days generally, or sometimes 1 day depending on the currency pair, but for the purpose of our argument we'll say that's immediate delivery. Okay, so let's for example look at euro dollar. Let's say the spot rate is 1.3. Then if you were to look at quotes for forwards, you'll see something like the following, where the exchange rate changes as a function of time. And in this example, these are all made up numbers, but you'll see that as you go into the future, the exchange rate is slightly higher. So this is the settlement rate. So when you trade a future, you exchange your currencies at a slightly higher rate than the spot rate in this example. So the purpose of this video is to explain why these rates are different from the spot rate. So as an example, let's look at euro dollar. So let's say you want to buy 1 million euros against US dollars, and we'll say the exchange rate is 1.3. So you do this and you put 1 million euros into your euro account, and you're overdrawn by 1.3 million euros in your US dollar account. And this is fine, but the interest rate in different countries may be different, and this is determined by central bank policy, among other things. I've just used some examples here. These are not the real interest rates as of today, but they're just used to illustrate this example. So if you have different interest rates in different countries, it means you'll receive a certain amount of interest on your euros and you'll pay a certain amount of interest on your dollars, but they may not be the same. So in this example, the interest rate on dollars is higher than euros. And if you go through to the future, you'll see that your cash balances will change by different amounts. So over a period of 180 days, if these were the interest rates, you'd find you'd lose about $5,000 just by holding the cash position. Okay, so you could also do this in reverse, of course. So let's say instead you sell 1 million euros and you buy 1.3 million US dollars because the exchange rate is 1.3. So this is assuming that the euro dollar exchange rate doesn't move, of course. This is if euro dollar remains at 1.3 for the next 180 days, then you will get a profit of about $4,800 just by having these balances in your account. However, in reality, of course, exchange rates do move. So you have some exposure here to the spot rate. And if you were to put on a trade this size, this graph here shows you how your profit would change as a function of euro dollar exchange rates in 180 days. So although you could in theory make profit, this is not a risk-free trade. But let's look at a different example. So if you could use forwards, you could carry out the following trade. So you do the same as before, you sell 1 million euros, you buy $1.3 million, but you also buy a 1 million euros of a 180-day forward contract. So if the forward rates were exactly the same as the spot rate, then you would buy this contract of 1 million euros, and the settlement price would be 1.3 in 180 days. So in this case, you would have the same exposure from your cash position, which is shown by the top graph. So for example, if euro dollar were to drop down to 1.28, you would make $20,000 for your cash position. However, you've also got this forward position, which means you would actually lose $20,000 from the forward. What this means is if you put on this trade, you have zero exposure to the euro dollar exchange rate. And what that means is that you can guarantee a risk-free profit of about $4,800 from carrying out this trade. So why is that an issue? Well, because this is a type of arbitrage, and arbitrage is something that the market acts to correct. So in theory, although we're talking about $1 million here, you could put on an indefinite amount of money. If you had the correct prime brokerage agreement and you could borrow as much money as you want, you could potentially put on an infinite amount of money on this trade. And that, of course, is not realistic. The market is driven by supply and demand, so forwards and futures will trade according to supply and demand. So the price will not be 1.3. It's the price that forwards and futures trade at is determined by where people are willing to buy and sell them. So basically, as you buy forward contracts, And you continue to do so because this arbitrage opportunity exists. And arbitrage, by the way, is a term used to describe a risk-free profit. As you continue to buy these contracts, you'll push the price up because there'll be more buyers than sellers, and that's just the way the market works. So what you find is that the forward price is not the same as the spot rate for this reason, because the market will always, it's a self-organized system, and it will always eliminate arbitrage opportunities. That's not to say arbitrage opportunities don't exist. They exist, but they're temporary, and the market is not completely efficient. But when we're talking about the theory of the market, we act as if arbitrage opportunities don't exist, or they certainly don't for a very long amount of time. So that's what you find. That's the reason behind why forward rates are not the same as spot rates. Here I've just used an example where the exchange rate, the forward price is higher than the spot rate. This is not necessarily the case. It completely depends on the rate differential between the countries.